Global central banks are on the hunt for the new normal in interest rates. Welcome to Market Insight, I'm David Pollard. With many global central banks now cutting interest rates, the question now is where is neutral in a post-pandemic financial landscape? In the US, markets have already made up their mind, it seems, pricing in a more than 60% chance that the Fed will cut by another 50 basis points in November, with further cuts in the pipeline. That in turn has moved stocks in anticipation of a return to lower rates. But how much has already been priced in? Well, joining me now to talk about all that is Young-Yu Ma, Chief Investment Officer at BMO Asset Management. Welcome, Young-Yu. Many thanks for joining us. In your notes, you say that unlike 2001 and 2007, this time the Fed's rate cuts are equivalent to pushing on a stick, not on a string. Can you explain what you mean by that?
Yeah, thanks, David. It's great to be here. When we say pushing on a stick, we think that these interest rate cuts are actually going to move the economy very directly and very quickly, rather than the idea of pushing on a string. For the past 2 years, we've had a nonstop drumbeat of recessionary concerns. We've had high interest rates that corporations and individuals are dealing with, and now we even have policy uncertainty relating to the elections here in the U.S. And we think once this is lifted, once these uncertainties are lifted, and once we get materially lower interest rates, there's going to be a lot of pent-up demand, a lot of spending, borrowing that takes place at lower interest rates, and we're quite optimistic about the effects on the economy being quite quick and impactful to really move things forward.
Well, now that the big global central banks have embarked on their easing cycles, there's much discussion about where that easing cycle is going to end in terms of the levels of rates. Where do you think the new neutral rate will be, given the prospect of possibly a new paradigm in inflation?
Well, this is something that central banks and the Fed are going to have to feel out over time. We think the markets have actually gotten quite optimistic about pricing in interest rate cuts from the Fed both this year and next year, and where that neutral rate is likely to end up being. We think it's actually going to be a little bit higher both than what the markets and what the Fed is projecting at this time, probably somewhere between 3 and 3.5%. We think inflation might come down to around 2%, but once global growth starts picking up, which we think it will next year, we think some of those inflationary pressures are not going to completely go away, and we're going to find that that neutral rate is a little bit higher than people are anticipating right now.
So how does that thought play through your expectations for November? Are you confident of another 50 basis points cut from the Fed?
We're actually not confident about getting another 50 basis point cut in November. The Fed sees the impact that this has had so far in terms of pricing in what's happening both in the equity markets and seeing the labor market stabilize as well. It depends on what happens in the job numbers, and it depends on what happens in the inflation numbers. But if we just get typical readings, I don't know that the Fed is going to be as enthusiastic to have another aggressive cut the way it had at the last meeting. It could very well be that the Fed wanted to come out of the gates quickly, but after that maintain a more gradual pace. So we'll have to see, but we're not as optimistic as the markets are right now in terms of pricing in another 0.5% cut in November.
And how does that play through where you see treasuries at the moment? In your notes, you comment that the 10-year in particular, in your view, is overvalued.
We think those longer term yields are likely to rise. We think they're going to rise for a combination of factors. Probably the least of those factors is the Fed cutting less than the markets expect. The more important factors we think are the acceleration of growth in 2025. And beyond that, we also think that once we get past the U.S. elections, there's going to be a much greater focus on fiscal deficits and the debt in the U.S. and what that means for longer term rates. And that's going to add a little bit of lift as well to those longer term yields. So we don't like duration here at this point. We think there's probably more upside risk than downside risk in those longer term yields.
And in terms of where stock investors look for value, utilities have already done very well on expectations of lower interest rates. Is that a sector you like, and what are the others that you like at the moment?
We do like utilities. If we look at what's happened to utilities, both over the past month and on a year-to-date basis, utilities are actually the second best performing sector in the S&P 500. But if you look on a 5-year basis, utilities are the second worst performing sector. So we think there's still a lot of catch-up trade in utilities, especially when you factor in the demand that's going to be needed for the build out of the electricity grid. We think that's going to underpin some of the optimism about the sector as well for years to come. Along with lower rates, we think that's a nice defensively positioned place to be, but also that allows for some growth. Besides utilities, we also like U.S. infrastructure. We think the spending is continuing to go into infrastructure areas, both from the private sector and from government spending, and that's going to take place for years to come. And there are a lot of forces coming together for that. And lower interest rates, actually juices that up a bit, and we think accelerates the process of spending over the next several quarters.
Okay, we'll leave it there. Young-Yu Ma, Chief Investment Officer at BMO Asset Management. Many thanks for sharing your thoughts with us today. That is your Market Insight. You can watch more videos on Reuters.com.